Welcome to the Deep Dive. Today, we are focusing all our attention on Duke Energy, that's ticker DUK, and specifically their third quarter 2025 earnings call.
Yeah, this wasn't just, another quarterly report. This felt like a blueprint.
A blueprint for dealing with this, massive demand shock hitting the Southeast utilities, correct?
This call happened intraday, November 7th, and it gave some really crucial insight into load growth and, maybe more importantly, capital allocation.
Especially with AI and electrification driving things.
Precisely.
So, our mission today. Let's cut through the noise. We want to pull out the key financial results, really get our heads around this huge Capex update, and map out how they're connecting today's demand surge to long-term earnings, durability.
Okay, sounds good. Let's jump straight into the results in the snapshot.
All right, so headline financials. They reported GAAP and adjusted earnings per share of $1.81.
Which was a beat. A solid one.
How much of a beat are we talking?
Well, consensus was hovering around maybe $1.74, $1.75. So $1.81 is roughly a 6-cent beat, about 3 to 4% ahead of expectations. Pretty clean.
And revenue.
Revenue also came in a little ahead, $8.54 billion versus estimates around $8.50 billion. That's up almost 5%, 4.8% year over year. So decent growth there, too.
Okay, and after that beat, they updated guidance for the full year.
They did. They narrowed the range for 2025 adjusted EPS, tightened it to $6.25 to $6.35, which, usually signals confidence they'll land within that band.
So good quarter, beat, tightened guidance, but the market reaction was interesting.
Yeah, that's the synthesis part, and it's where it gets a bit tricky. Despite all those positive headlines, the stock basically went nowhere. Traded flat, maybe even slightly down during the day.
So why the shrug from investors? If it was a clean beat, why no reward?
It feels like a classic case of the market looking past the immediate quarter. It's like investors are saying, okay, $1.81 is nice, we see that, but this massive capital plan you just unveiled, that's what we're really focused on.
The $100 billion question, literally.
Exactly. The execution risk, the regulatory hurdles, potential cost overruns on a plan that big, that seems to be weighing more heavily right now than the $1.06 beat. The focus totally shifted to the long term.
Okay. Let's put a pin in the risk for a second and unpack the strength in the quarter itself. What actually drove that $1.81 EPS?
Well, the core drivers were pretty fundamental. You had new rates and riders kicking in across their service areas. That's always a big help.
Standard utility playbook stuff.
Right. Plus higher retail sales volumes, people just using more electricity. So the main segment, electric utilities and infrastructure, saw adjusted income jump by $1.24 per share compared to last year. Quite strong.
But it wasn't all smooth sailing. There were offsets.
Naturally. Higher interest expense, that's hitting everyone. Weather was actually milder than last year, which, means less AC, less heat and demand.
Always a fact.
And then you have the sort of unavoidable costs of growth. Increased depreciation because they're building more stuff, and higher property taxes on that growing asset base. Oh, and the adjusted effective tax rate was 10.8%. Lower tax rate helped a bit.
So a mix of tailwinds and headwinds, but the underlying demand is clearly pushing them towards this big strategic shift.
Absolutely.
Yeah.
Which brings us right to the main event of the call. Load growth. Management just kept coming back to it. This accelerating demand, especially from data centers and manufacturing coming back on shore.
They put some hard numbers on the data centers, didn't they? Something like 3 gigawatts.
Yeah, 3 gigawatts in energy service agreements, ESAs, signed just this year. That was a standout number. They mentioned deals with big players like Digital Realty and Edge.
Can you just quickly explain what an ESA actually means in this context? Is it like a firm commitment?
Think of it like a rock-solid contract. It's a guarantee from a big power user like a data center operator saying, yes, we will need this specific massive amount of power starting on this date. It takes demand out of the maybe pile and puts it firmly into guaranteed revenue. And 3 gigawatts in, 10 months? That's a scale Duke hasn't seen before.
Right. And that guaranteed load is what forces their hand on the capital spending, the Capex cliff, as some might call it.
Precisely. That leads directly to the refreshed 5-year Capex plan for 2026 through 2030. They're now guiding to between $95 billion and $105 billion.
Wow. $95 to $105 billion. That's a staggering number.
It is. It's a fundamental step up. It reflects the need for over 13 gigawatts of new generation capacity just in the next 5 years. This changes the whole profile of the company.
So how do they connect that massive spending back to shareholder value? What's the long-term promise?
Well, they reaffirmed their long-term EPS growth target, that 5 to 7% compound annual growth rate, or CAGR. through 2029. But here's the key part. They express high confidence in hitting the top half of that range. So think 6% plus.
Okay, but not immediately.
Right, they flagged 2028 as the inflection point. That's when these big data center projects are expected to be fully online, generating revenue, and also when some major investments down in Florida wrap up. That's when the growth really starts to accelerate, according to them.
But spending $100 billion, how do you do that without crushing customer bills and facing huge political pushback? Affordability must be top of mind.
Absolutely critical. They outlined sort of a three-pronged approach to manage costs while funding this growth. First, the usual, discipline cost control internally, keep operations lean.
Standard procedure.
Second, they're really leaning on federal energy tax credits from things like the Inflation Reduction Act. They're talking hundreds of millions in annual savings that get passed through to customers, which helps offset the investment costs.
And the third lever?
Storm cost securitization. This is a bit more technical, but important.
Yeah. Break that down for us. Securitization sounds complex.
It basically allows them to smooth out the recovery of massive storm restoration costs. So instead of hitting ratepayers with a huge bill increase immediately after a hurricane that caused, say, $1 billion in damage.
Nobody likes.
Right. They issue bonds backed by future customer payments to cover that cost up front. Then they collect smaller amounts from customers over a much longer period, like 10 or 20 years. It makes the hit much less painful. For North Carolina, they reckon it could save...
Meaning the data center has to pay for a minimum amount of power, even if they don't use it.
Exactly. And significant termination charges if they back out. Plus, refundable capital advances in some cases. The idea is to make sure these massive new projects pay their own way and don't leave existing customers holding the bag if plans change. The new growth has to cover its own risks.
Okay, that makes sense. Shifting gears slightly to the investor context, this whole $100 billion plan lives or dies based on regulatory approvals, right? What updates did we get there?
We got some important green lights. In South Carolina, they reached what sounds like a pretty constructive settlement in their electric rate case, based on a decent return on equity, 9.99%, and a strong equity ratio in the rate base, 53%. That's supportive.
Good news from South Carolina. What else?
Big news out of Indiana. The commission there approved the CPCN for their big Kaiba combined cycle gas plant project.
CPCN, that's the Certificate of Public Convenience and Necessity, basically the main permission slip to build.
That's the one. Crucially, that Indiana approval also includes a mechanism called a semi-annual recovery rider.
Okay, what does that do?
It means Duke can start recovering some of the construction costs while the plant is being built through customer bills. This is huge for their cash flow. It helps support the balance sheet during this really intensive construction phase rather than waiting years until the plant is finished to start getting money back.
That seems like a significant win for managing the financing strain.
Definitely. And speaking of cash flow and customer bills, they had good news for Florida customers too.
Right, the storm costs.
Yeah, that remaining $1.1 billion in costs from past storms, expected to be fully recovered by February 2026, which means come March, Florida residential customers should see their bills drop by about $40 a month.
That's a nice headline for customers, but for Duke, getting that $1.1 billion off the books and the cash recovered, that helps their balance sheet metrics too, doesn't it?
Oh, absolutely. It improves their funds from operations, FFO, which is critical for their credit ratings and overall financial health. They're targeting a long-term FFO to debt ratio of 15%. They expect to hit 14% or maybe even a bit higher by the end of this year. That's the number investors watch closely to see if the company can actually handle its debt.
And financing this $95 to $105 billion plan, they mentioned needing a fair bit of equity funding.
Yeah, the target mix for the incremental capital, the new stuff, is 30 to 50% equity. That sounds like a lot of potential share issuance down the line.
Which can dilute existing shareholders.
It can. But here's the near-term positive. They expect the proceeds from selling off assets in Tennessee and Florida. Those deals should close early next year. 2026 will cover all their common equity needs for the entirety of 2026.
So no need to issue new stock next year.
That's the expectation. It gives them significant breathing room. They can focus on getting these projects started without worrying about tapping the equity markets right away.
Okay. One other strategic piece we have to touch on is nuclear. Given the sheer scale of power needed, what's the latest there?
They confirmed they are actively looking at it, both large traditional reactors like the AP1000 design and also the newer small modular reactors, SMRs. These options are formally part of their updated resource plan for the Carolinas.
But are they actually pulling the trigger?
Not yet. They're being cautious.
Right.
They explicitly said commitment is contingent on figuring out two big potential roadblocks. First, how to get protection against major cost overruns, which have plagued past nuclear projects.
Understandable.
And second, how to structure it so a massive nuclear bill doesn't completely blow up their balance sheet during construction. So evaluation, yes. Commitment, not quite yet.
Makes sense. So wrapping up this section, if you're an investor trying to track this story, what are the key things to watch for in the coming months, the catalysts?
There are three main ones, pretty clearly laid out. First, we need the final detailed version of that $95 to $105 billion Capex plan and the associated financing strategy. That's due in February.
Okay, February for the full plan.
Second, they're filing new rate cases in North Carolina later this month, November. Those filings will be crucial to see how they propose recovering costs for the initial phases of this build-out.
And third,
Just continued momentum on those data center ESAs. That 3 gigawatts signed so far is impressive, but they need to keep that pipeline flowing. Every new major contract they announce validates the demand story.
got it. Okay, let's move to our favorite segment.
Acknowledging, of course, this is not financial advice, purely for entertainment idea generation. We are not your financial advisors. Please do your own research.
Right. So we've talked about this disconnect, haven't we? You've got this clearly accelerating load growth, this monster $100 billion Capex plan rolling out, but the stock just yawned after earnings.
Yeah, the market seems totally fixated on the near-term risk and is maybe missing the long-duration story here. The guaranteed nature of regulated returns seems undervalued right now.
So the trade pitch.
It has to be long-term and leverage the potential upside if they execute. We're thinking long-dated, out-of-the-money call options, like expiring maybe 2027, even 2028.
Okay, why options and why so far out?
Well, the options give you leverage, cheaper exposure to potential upside than buying the stock outright. And going far out gives the story time to play out. We're essentially making a bet that the market is fundamentally misjudging the power of rate-based compounding.
All right, remind us rate-based compounding in simple terms.
Basically, every dollar Duke spends on approved projects, power plants, transmission lines, grid upgrades gets added to their rate base. That's the asset pool they're allowed to earn a regulated profit on year after year, often for decades.
Because this $100 billion isn't just spending, it's locking in future earnings.
Exactly. It's building the foundation for potentially accelerated compounded earnings growth well into the 2030s, especially if they hit that top half of the 5-7% EPS growth target they're aiming for starting in 2028.
So the trade idea is buying relatively cheap, long-term calls to bet on that 2028 inflection point and beyond, assuming management delivers on this data center-driven plan.
You got it. We're wagering that today's muted reaction is temporary, a market misunderstanding of just how significant and durable this growth phase could be for a utility like Duke.
Okay, so let's try to boil this all down. What's the core takeaway from this deep dive into Duke Energy's Q3 call?
I think it's pretty clear Duke is shifting gears. They're moving past a period of just stabilizing things and are now entering a phase of really mandated, scaled growth. It's being forced on them by this unprecedented demand from electrification and AI.
Underpinned by what seem to be generally supportive regulators in the Southeast.
Right. And management sounds confident. Strong momentum going into 2026.
Yeah.
They believe this growth story has legs well into the 2030s.
Okay, so here's a final thought to chew on. They're planning 7.5 gigawatts of new natural gas capacity alongside looking at nuclear, mainly to meet this immediate AI-driven demand spike.
That's a significant amount of new gas generation. It highlights the need for dispatchable power, power they can turn on quickly when needed.
So the provocative question for you, the listener, is this. Can Duke, or really any utility in this position, truly balance the urgent need for massive amounts of reliable, fast-ramping power for data centers with their stated long-term goals for decarbonization? And looking ahead, what's ultimately going to move the needle more for Duke's value? Successfully landing all this data center load or making real, tangible progress on bringing new nuclear power online? Which horse do you bet on?